It's sunny March. Can you believe it? We're heading into a new tax year. And if you've been following the markets like most of us do, you'll know that it's very, very volatile right now. There's a lot of stuff going on. Interest rates are increasing. We've had Silicon Valley Bank. We've had Credit Suisse. So today, I'm in London on this rooftop. I mean, look at this right here. And I'm going to be talking to some professionals about volatility and, more importantly, how you as first-time investors can actually manage volatility and how important it is that you manage the volatility. Is it a good thing? Is it a bad thing? And I'm going to be speaking to one person in particular who needs no introduction of her own. She's been on CNN, she's been on Bloomberg, and it's a great honor to be able to sit down with her in conjunction with IG. But first, let's just appreciate where we are right now, and let's get this drone shot going. In this part of the segment, we're going to talk to Angeline Ong, who has been around for a very, very long time. And I don't want to do disservice to you in introducing what you do and how long you've been around for. So would you mind giving a brief introduction of yourself to the viewers, please?
Of course. So thank you so much for having me on. First of all, I've worked in finance for a very long time, serving CNN Financial News, Bloomberg as well, and also Reuters, and now IG, where volatility and understanding the markets for our clients is a key trading opportunity.
And that leads us into the first question. I obviously speak to a lot of first-time investors, and in times like this, there is a lot of volatility, a lot of uncertainty. We're looking at the backdrop of, monetary policy changing. How do the professionals like yourself and IG view volatility? Is it a good thing or is it a bad thing?
Well, volatility is like the weather. Look, it's not a bad thing, it's not a good thing. What's key is understanding volatility. You don't fear the weather when you go out, do you? Mm-hmm. You understand whether it's going to be a sunny day or a rainy day and you dress appropriately. The same with trading and investment and finance. It cuts out the fear, it cuts out the noise. If you know what you're doing, then you're in a good place.
So how would you describe volatility in just like a very simple manner for first-time investors to understand?
Volatility allows you an in point and an out point. If you know where to come in and where to exit, that's where your margin is. That's where you're going to be in a good place. For example, if you knew which way volatility was going to take energy prices, you'd be able to then understand what sort of contract you need for your risk profile.
That's interesting that you actually put it that way. It gives you an in point and an out point, because often when I kind of describe volatility, I talk about, it is the movement of the market up and down. But what you just described there is actually, it's a little bit more pointed and focused in the fact that what you're looking to do really is you're looking to find your entry point and your exit point, looking for margin between those 2 points, essentially.
Exactly. And knowing where your in point and out point is the secret to all this. If you know exactly how much you're going to expose yourself, exactly where you're going to be placed, what sort of asset, when you're going to invest and when you're going to unwind that investment, then there is no panic, there is no worry. It's almost like picking a house that you're going to buy. If you've done all your homework, you know exactly where you're going to buy, even down to the detail of parking there at night, looking at the people that walk on the pavement, liking the dogs they're walking. That is homework, that is investment. If you're actually just buying a house and just picking an area, that's not investment, that's betting.
Yeah, I would agree with that. In the context of what's happening right now, I have various conversations, and energy prices, you kind of gave that example there, right? There's a lot of, I guess, discontent, I would say is probably the right word, with energy companies, because they're very, very profitable in times like this, right? And one of the things that I always talk to people about is, yes, we're consumers of these companies, but actually if you're an investor, this is probably a good time for you. You talk about the volatility and knowing what the direction of travel is for a company or for a sector like energy, for example. How important is that from the outset when a first-time investor kind of looks at investing and goes, right, I want to put some money in, where do I go?
Well, I would say look first at the company, the fundamentals. You can also look at the technical analysis, so what the actual share price and the volumes are telling you about that company. And of course, the key thing also not to forget is what the wider world is doing. So where is the Ukraine crisis headed?
Mm.
What's Putin going to do next? What are government regulators are doing to the energy market? All that feeds into your investment decision.
So you made a really good point there around volatility and the direction of travel, because what I find is that when at least people that I interact with on the channel, they'll see a volatile period, they come out of the market, and maybe there's a little pre-work that they don't necessarily fit in terms of understanding what their goal is, their risk profile, so on and so forth. In the relation to volatility and direction of travel in whatever investment you're making, is it possible to divorce those two things, or are they just intrinsically linked and forever will be linked?
Look, you need to look at both sides. They are linked. It would be probably not a good idea to de-link them or decouple them, because both affect the other. And what I would say is to take a broad view, understand your risk appetite, how long you want to hold this financial asset for, and then take the right move. Your risk appetite might not be the same as mine, right?
Yeah.
Everyone has
Yeah.
a different time frame.
Yeah.
And so bear that in mind. Understand, don't overexpose yourself. Understand what your risk profile is and act on that.
Yeah. And for you guys as professionals doing this now, how do you approach volatile times like this in the markets?
Oh, it's a really exciting time. Times like this give us trading opportunities that you don't see very often, because it's when the markets move a lot, that's when you get a lot of in points and out points, whether it's buying long or going short. It really gives investors the ability to step in when markets can change quite dramatically. Yes, there is a lot more risk, but there is also this ability to gain from these periods.
Yeah. So from your point of view, I mean, obviously you're an institutional, really experienced company. How do you approach that risk element to it on your side then? Because like you said, everyone has a different level of risk, and for retail investors, very, very different to maybe perhaps an institution like yourselves. What are the key components that you're looking at when you're looking at the risk element to enter in the market in volatile times?
I'd say understand how much risk and exposure you're willing to take on first, and then treat it almost as if you were going on a date with someone.
Okay.
It
I
might
like
be
this
going
analogy
really
already.
well.
Yeah.
That person's looking great and they tick all the right boxes. But then do your homework. Find out what their parents are like. Find out, what their job profile is, whether the outlook is good for this date, because you might find out something you don't like.
Yeah.
That's the time to unwind.
Yeah.
However, if the outlook is good, if this person turns out to be someone who could be, further up along the career, there's someone who you can work with, someone that shows promise, then it's a buy.
Yeah. And how do you manage the equation of, right, so there are things that you like, there are things that you don't like, because you're never going to have a perfect picture where it's 100% positive. This financial asset is great. There's always going to be a negatives. How do you balance that out?
Clearly, there are things or financial assets that certain people like and those that you don't like. You have to understand each financial instrument and how they interact with each other. During uncertain times, money comes out of equities and they tend to flood into fixed income or safer assets like money markets. When it's calmer, money goes out of those safer or deemed safer assets into equities. Understanding the flows help you understand which financial asset is likely to benefit or not benefit in those times.
And obviously that's in context to what's going on in the wider picture as well, directional travel of whatever it is that's happening in the world as well, because that will also have an influence in factor on it as well.
Exactly.
After speaking with Angeline, I wanted to find out if there's any behavioural pitfalls retail investors fall into, and so for that, I went to find Christine. Christine, thank you so much for joining me for this segment of the video. Introduce yourself very quickly for the viewers who have never met you.
Absolutely. So I have the privilege of being a user experience researcher at IG. So I get to talk to our clients about what they like about our products, services, and platforms. And so talking to clients all day.
Okay, so you got the cold face, seeing how they're feeling, and sort of making the product better. Essentially.
Yes, ideally. Yeah, not worse. We don't want
That's
that.
what we all want.
Yeah,
You want
we
better
don't want
products.
that. We don't
Better
want that.
products.
Yeah.
So tell me, obviously, we're in a period right now where there's a lot of volatility. Retail investors are a little spooked, unsure what they should be doing. I'm interested to know, as a professional company that does this on a day-to-day basis, are there any patterns that you've seen or noticed within retail investors when markets are volatile that you find to be quite fascinating?
I think that there's a few different things that we see depending on the level of comfort and experience people have with their investing. So you've got the people who sort of buy, holds, regardless of what the market does, they just hang on, up and
For
down.
dear life.
Yeah, exactly.
Yeah.
For dear life.
Diamond hands, as they say.
Yeah, and
Yeah.
you've got people who are a bit more considered and thinking about, okay, if the stock market maybe isn't doing as well, maybe I'm deciding to shift into different areas. So that I'm maybe in safer investments. Or you've also got people who are wanting to take advantage of the volatility too, right? So they're looking at opportunities maybe in the banking sector because they think that some of these banks are going to be long-term great investments and maybe are on sale at the moment. And so it's a good time to get in.
That's an interesting point you make there. So how do you see that the patterns are different based on experience and how long people have been investing for? Because I think during recessions, banks and financials tend to do really, really well because we all need financing. How much of that experience and knowing and having maybe that little bit of this has happened before, this is what we noticed, how much does that play into it?
I definitely think that that's a big factor. People who have been investing and interested in the markets for a long time are those people who are more comfortable understanding when they want to shift their money around to be able to take advantage of different opportunities. And that's something that we can all aspire to, right? Learning more about the markets so that we can take advantage of these opportunities when they come up.
Yeah. So do you find that it's more people kind of being a little, I guess, reticent around what decisions they should make, or because what I find is a lot of people that follow my channel and interact with me, they're very much first-time investors. So they're trying to learn the ropes. And times like this spook them out more than anything else. They're really, really worried. So what I notice is they'll be invested in something. The minute it gets a little bit choppy, you know what I'm going to say. They jump ship, get out, and then they try and find the next best opportunity to be in, where sometimes it's like, well, okay, what was the whole plan from the outset? Do you notice that a lot with the guys?
Yeah, I think that it definitely happens, right? And then you see this cycle of them constantly entering into investments at the worst possible time, which is absolutely heartbreaking. And so I think that that is something that we see. We talk to people. One of the things that we ask people about is like, what's the worst? What was it? What was your learning experience? We call it. And you do have situations where people are talking about that there was this big hype around something, and so then I got in, or where something it tanked. They got in and it tanked, and that's what I feel like happens to me every time when I make an investment. Is that I get in and then immediately the market,
like that, though, doesn't it?
Immediately
All
the
the
market
time.
goes down, and I'm like, come on! Clearly, somebody's strategy should just do the opposite of what I do. But there's definitely situations where they do get really spooked, and so helping people have an understanding, better understanding of markets, so that they know that these things are cyclical. It will come back. Stick to your strategy.
How important do you think psychology is?
I think it's key. Like, I think about the investing that I do personally, and I'm terrible. Like, I am constantly like checking my phone, and it's like it's up 3 points, it's down 3 points, and I'm like, oh my god, I'm going to retire and end up eating cat food, right? Like these are things that we worry about, and so I personally have to get much better at being able to step back from things and think about what my long-term strategy is, so that when I'm retiring or closer to a retirement age, that I've benefited from the fact that I have been saving and investing for all this time and not just getting in and out, as you say, either like following the herd or FOMO, FOMO investing in terms of whether I'm going to go into something ridiculous.
So one of the biggest things that you're going to struggle with, and all investors struggle with, is volatility and managing risk in times like this where it feels as though there's a concoction of just things happening to negatively impact our investment journey. That's the whole point of this video. It's to speak to professionals who do this day in, day out, so that you can hopefully take a little bit of something, a little tip, and actually incorporate it into your own investment journey. Now, we will have 3 videos in conjunction with IG on the channel that will come very, very shortly. I'm really excited about it because it's going to cover 3 different topics. And when we talk about investing specifically, try and pull out some really important lessons. So stay tuned for that. But in the meantime, if you want to learn a little bit more about risk and risk management, because it is really important, and I know that I say this all the time, you can go onto the IG Academy and look at some of the content over there. It is free for you to do. Until the next video, catch you later on.
I feel like volatility is an opportunity. So whenever the markets are flat, it's harder to invest. When there's things going on, going up and down, then that's the opportunity.
How do I feel about volatility? Volatility is nowadays something that you can see in the markets almost every day. Especially during the COVID pandemic, we've seen lots of volatility disrupting the business as usual of many organizations. The way to deal with it is to learn as much as possible of how to prevent excessive risk taking, for example. But I think it's something that we have to learn how to live with.
It's exciting. There's opportunities to take advantage of the market when there is volatility using various investing products that are available through different brokerages, etc.
It is something that I have to kind of like practice my emotional intelligence, having the strength to deal with it, that it can come anytime, like anywhere, by any channel. So it's like something that like kind of related to emotional intelligence, I think.
I'm not too affected by volatility because, I'm a long-term investor, so I have a long-term horizon. So I'm less bothered by price movements day to day, but obviously I am cognizant of it.